right, morning everyone. Welcome to another STANLIB webinar. We're going to be talking all economics today. Most of it not good news, I'm afraid. And some of it become a little bit more detail orientated, especially around inflation, I guess. Not so much technical, as just the detail matters. That isn't always the case, but I think under current circumstances, understanding some of the sub-detail on inflation is particularly useful. So we're going to be talking about what's happening in the US. I'll spend quite a lot of time talking about their trends, what's happening to growth, what's happening to inflation, interest rates, those types of dynamics. And then we'll talk about South Africa in a bit of detail. I'm not convinced that I can highlight anything most people don't already know. But there are a couple of key issues that I think are worth reminding ourselves about. And certainly one of them is that even before the significant acceleration in load shedding, this economy was not doing well. And I'm a little bit concerned that we're tending now to attribute a lot of the negative in the economy to the electricity outages. And undoubtedly, yes, it is a massive factor, and it's a factor that holds back the development and progress of the economy. But it's not the only factor. And therefore, even there's a lot of work South Africa has to do to get us onto a better growth path, even if you've got better electricity production. That's what I'm going to try and illustrate. And then we'll talk about the medium-term budget that's next week. We'll talk about, I'll show you how much cash corporates have got. Corporates in South Africa are in great shape. They've got actually, honestly, tons of money. They just constantly lack confidence. And I guess you could argue they lack a bit of vision. I think that is a factor. But at least they're in decent shape. So we'll chat about that a bit. We'll chat about our inflation and interest rates. So a fair bit in the next 40 or 50 minutes. Please, if you want to ask questions, please just type them in the questions section. I'll monitor that. There is a Q&A section. So as we go along, I'll be monitoring that. I can't promise to get to everybody's question, but as I go through it, if there's anything that pops up that you want to maybe just need a little bit more explanation, I can delve into that. I'll just simply interrupt myself to take that question. Also, in order to get CPD points, you've got to stay on to the end. And as usual, if you want a copy of any of the charts, it's freely available. Just reach out to us, or it'll be on our website. And if you want other stuff, there's so much information around. And obviously other areas I won't chat about. China, there's huge developments there with the Communist Party conference. So if you've got some time at the end, I can chat about that. Europe, I see Europe, the consensus forecast for Europe for next year is a recession. There's a significant development in Europe in terms of acknowledgement that economy is under huge pressure. So initially the discussion was, well, Germany's going to have a recession, and most people have moved their data to show that Germany is likely to have a negative year next year. So when I'm talking recession, I'm saying the GDP for the year in total will decline. So initially it was Germany, Italy, part of that, but it's broadened beyond that, and now it's essentially the whole of Europe is expected to have a recession next year. Their confidence level is actually at the lowest number ever recorded, consumer confidence in Europe. And a big part of that is simply the Russia-Ukraine crisis that persists, and this constant threat that it could develop into something of a nuclear nature, which would be catastrophic for the world economy and for financial markets. So I can understand why Europe is really, really struggling, but you're still seeing downward revisions across most economies. The IMF on their data showed across the board downward revisions. But I think that most people are marking down their expectations for growth for next year. Not so much this year. This year is pretty much done, but it's all around next year. And we're going to see more revisions to recessions next year. So there's no doubt that economic outlooks are worsening. There's actually a question here around China. Is there a policy mix? So let me just quickly highlight this on China, because I think it's quite important. So if we go back in time, not that long ago, there was a bit of a reliance on China bailing out the world economy. They certainly did that at the time of COVID, right? So they had a limited impact of COVID and they provided their own stimulus, but they did that enormously after the global financial market crisis. And there has been this expectation that, no, don't worry, China will switch on their economy. And they will help to get the world going. And they've got the financial ability to do that, and they've clearly got the system that will allow that to happen, right? Because of the central control, they're able to get economic activity moving very, very quickly if they choose to do that. What seems to have evolved, though, in China now is not that. It's very unlikely they will switch on their economy and therefore negate the negatives in Europe and negate the negatives in the US. At the start of this policy conference, this Communist Party conference, they were saying that it's all about measured growth. It's not about growth for the sake of growth. So they're focusing much more on appropriate growth or quality growth, if you like, and not just simply saying we've got to get a GDP number at a certain level and we've got to do what's required to achieve that. So all of their utterances, all of their policy statements are not around simply boosting growth. It's around, let's be more considered. The other thing which I think we need to be concerned about, there's a definite element of inward looking that's happening out of China. Now, you could say that's part of deglobalization. In other words, the rest of the world is not playing as nice with China as they used to, certainly the US and other countries. China's obviously to some extent aligned themselves with Russia, which creates a bit of isolation at this stage. But I sense that there's more to it than that, and that China's antagonism towards Taiwan has ramped up. And so I think they focusing internally. They keep saying they want to be more self-reliant. They want to depend less on the world economy. I think they're going to up their aggression on Taiwan. And if you take the two together, it is arguing for more measured growth that's inward looking, that's more self-sufficient, that's less beneficial to the world economy. And I think that's very important. So I don't think China is going to come to the rescue, if you like, of the world economy at all, actually. We'll see what happens at the end of the conference. The conference ends on Saturday, and I guess there will be more formal statements issued along the way. So we'll get a better sense. The other thing just to remember about China is this is their Communist Party conference. So a lot of the statements will have that tone to it. It doesn't mean that that permeates the entire economic system. The Communist Party isn't perhaps as powerful as they used to be, but they're certainly very influential. There's a question on the Fed. Has the Fed lost the ability to forecast? Well, so we don't know that, but they definitely missed a huge forecast around their own inflation. And then I must say that's surprising, because the data and the analysis generally out of the federal system is just phenomenal. So if you read all the different areas where they produce reports, each Federal Reserve has their own set of reports. They do phenomenal work. And the fact that they missed the increase in inflation, it's surprising. And I guess a lot of people want that explanation. They want the Fed to sit down and say, why did we miss this forecast? Is it something to do with our systems? Is it something to do with a bias in the way we analyze? Have we changed anything so that we can improve our forecasting ability? I haven't seen anything like that. And there's needs to be an owning up from the Fed regarding the mistakes they've made around inflation. And therefore, have they improved that? Can we rely on their forecast going forward? The private sector has been way better than the Fed in forecasting this, and I think actually continues to be, although there's a lot of politics that enters those forecasts. Yeah, so I can't answer that question properly, sorry. What is expected EU recession, loss of GDP? So at this stage, you're looking at a decline in Europe of less than 0.5% next year. It's not as if you're looking at a deep recession, 2% decline in GDP. That's not the expectation right now. But you can see the pattern. The pattern is month by month, the data has been revised lower. So there's no doubt that these numbers are going to get worse before you get to the right number. In other words, this view that, okay, this is as bad as it gets. So it's possible that Europe ends up with something like a minus 0.5. I still don't think this is a global crisis unfolding. I don't think that. But I do think this is a very significant slowdown / global recession that we're heading into that will clean out a lot of the system, or clean up the system, and that the central banks are not going to simply stop hiking rates or start to cut rates very aggressively because economies are under pressure. That's not the name of the game at the moment. For the central banks, it's honestly all about getting inflation under control. And once they're comfortable that inflation's under control, yes, then they'll cut interest rates. But they're not going to cut interest rates to stop the pain in the economy. They can't afford to do that. They'll lose even more credibility. Question, do you have a concern about the Chinese property market? Absolutely. I think it's a slow implosion at the moment. And if you delve into it, and one of the ways to do that is just try and read a lot of the website comments and kind of day-to-day discussions in China, and not just the data. There's a lot of anxiousness around the property sector, and there's kind of a turning away from property as an asset class within China, because it's not doing what many people thought. There's been a lot of speculation in that market. So I'd be concerned that you need to get a significant clean out, including a clean out of property developers, and then see if you can kind of get a better base. The difficulty, I think, is that the government's going to be looked at to make good on some of these developments that can't be honored. So the government's going to find themselves under pressure to support property owners, but allow the developers to go out of business. Difficult phase for them. Okay, let's get going with the presentation now. Otherwise, I'll just spend the whole time answering questions, but the questions are very good. Okay, so let's start with the presentation up on the screen. That's always, I guess, a useful place to start. So the focus everywhere in the world's inflation, and it's very rare, if you look back in time, that we would ever start a presentation with an inflation chart. It just doesn't really happen because for decades, inflation has been mostly under control around the world, and there have been some rogue countries where inflation is a problem. But so this is a unique situation, and we've got to acknowledge that inflation around the world remains problematic. And it's not as if every single country has an inflation problem, right? China doesn't really have an inflation problem. The inflation rate has moved up a little bit in the last 3 months, but it's very manageable at this stage. But the vast majority of countries still have a significant problem. If you see the UK data came out this morning, UK inflation out this morning, it says 10.1%. It's re-accelerated in the UK, a lot of food inflation, and then they've still got all of that energy inflation that's re-accelerated. So and Europe's inflation is 10%. And when you look around, it's very common now, well, not common, it's very prevalent that you'll see countries with double-digit inflation. Obviously, there are countries with extreme numbers. So you've still got Turkey. I think Turkey is at 82% inflation, if I remember. I think they've gone up to 82, but they just manage their economy in a ridiculous way. I think if you go to a place like Argentina, they've got about 78% inflation. So there are some countries with exceptional numbers. And then there are one or two countries that I think are going to be interesting to watch where inflation has rolled over. And I would flag there Brazil. Brazil, the inflation number has rolled over, and they've got a different stance developing on interest rates. And it's going to be interesting to see how they take things forward. And I'll tell you why, is because there is this worry that you have to keep hiking as long as the Fed's hiking. And that if you break ranks with that, in other words, you decide, no, I'm going to have my own monetary policy. I'm not simply going to follow the Fed. Then you're going to get punished in the financial markets. And that was kind of, not in the same way, it's kind of what happened to the UK, right? So there's a bit of a worry that even if countries don't need higher interest rates, that because the Fed's hiking rates, countries will be forced to hike rates. And in South Africa's case, that's going to become a problem next year because our inflation rate will be moving lower. We don't require higher interest rates. Are we forced to keep hiking because the Fed's hiking? That would be terrible. So we need a group of emerging markets that break ranks, that say, no, we've done enough on interest rates and we're going to keep interest rates unchanged with a view to cutting rates during the course of next year. And one of the countries to follow with regards to that argument is Brazil, because Brazil's had a clear rollover of inflation already. And do they start to break ranks? That would be useful. So when you look at global inflation, major problem. When you break that down between developed and emerging, major problem in both areas. I guess for emerging markets, they're further along in the process, I would argue. There's more evidence of emerging market inflation topping out and starting to roll over. I think that's fair. And everybody's got base effects. Everybody's going to have a massive base effect in food next year and a massive base effect in energy. And so the forecasts for next year show inflation everywhere in the world moderating. But we've got to just be clear that a lot of that moderation is base effects, statistical rather than necessarily policy induced, but clearly policy is going to help. And the slowdown in global growth and the risk of a recession absolutely is going to help. But it's not as if that's the only factor. The base effect is going to have a huge impact here. And alongside of that, obviously, most countries continue to hike rates. Again, emerging markets are a little bit further along. There's more evidence that they started earlier and they will reach the top of their interest rate earlier. And therefore, they would probably start to cut earlier. I think that's fair, and that applies to South Africa. And there's no doubt that developed markets have been behind, right? It's not just the US. We keep focusing on the US, but I would argue that the ECB is massively behind the curve here, and that in general, developed markets were late in identifying the inflation problem. And part of that is simply they got so used to inflation being low for such a long period of time that you wouldn't think of inflation becoming this problematic. It's very hard to adjust your models to take account of these types of developments. So interest rates are going to keep going up, especially in the United States. And when you look at the United States, it's important, I think, to recognize that because they were late in starting the interest rate hiking cycle, they now have to accelerate it. So look at the previous interest rate pattern. So this is all US interest rates, and each line just represents the previous hiking cycles. Now, what's important here is not the level of increase in rates, but the speed of increase, which you can see on the bottom axis. So how many months? And in this case, this is the fastest pace of rate hike in the US has experienced for a long time. Now, that reflects the fact that they have to catch up. They call it front loading, right? But front loading is just another way of saying that you were behind the curve and now you have to catch up. And they'll continue on this accelerated pace to get to a level that they're more comfortable with. So you've got to expect, they've got 2 more meetings this year. You've got to expect at least 75 basis points at the next meeting, probably at least 50 basis points at the final meeting of the year, and then further rate hikes early next year. And I think that's fairly assured at this stage. And so you're starting to talk about a federal funds rate that goes to 5%. That's entirely feasible. And therefore, it would, by historical standards, be seen as a fairly aggressive rate hiking cycle. But I think that's what's required in order to get this under control. And so we're going to talk about inflation in the US in a little bit more detail to explain why they need to be this more aggressive in terms of interest rates. The problem with this, when you hiking rates this quickly, there's a problem. And that is you're not giving time to assess the impact of your rate cycle on the economy. And that's absolutely critical. When you take a long time to hike rates, all along the way, you can read the data at your leisure almost. You're not hiking every meeting. You're waiting for data to come in. You're assessing whether you need a further hike. Then you're hiking, then you're waiting, etc. That process is way better because you can then be clearer about what's required in terms of interest rates. When you increase rates very quickly, you've got hardly any time to get new data in. And therefore, you can over-tighten quite easily because by the time you get the data that confirms that you've over-tightened, you've already over-tightened, if that makes any sense. So there's a big risk that the Federal Reserve, in catching up, you run a risk. And that is that you go too far, too quickly, and you don't know that. You just don't know it. The data takes time to tell you that. But the Fed has no choice because they started late. That's the problem with starting late, is you've got to run like incredibly fast to catch up. And then only can you stop and look around and see what damage you're inflicting on the economy. And they're still in full sprint mode. They haven't stopped running here, and they're going to continue to hike rates aggressively. Okay, so let's understand this inflation problem in the US in a little bit of detail. And I need to apologize because this is going to feel like a little bit more detail than you would really want. But I've kind of evaluated this over and over, and I think the detail is important. I'm going to go through it fairly quickly because it is micro detail, but I think it is important. So when it comes to the US inflation story, two problems remain, and they're gonna have to deal with these two problems. The one is shelter inflation and the other is wages. And they have big implications for how inflation turns out during the course of next year. So on shelter inflation, which is rental inflation, this is a very complicated story. The initial run-up is not complicated. All that happened was the demand for housing was exceptionally strong, phenomenally strong. House prices rushed up dramatically. I'll show you that. I'm going to skip forward 2 charts. So look at what happened to house prices. That's an incredible acceleration in house prices during the COVID era. So go back 2 years and look at that. Look at the angle of this curve over the last 2 years. And house prices were at a record high before COVID started. And then prices go up another 40% in 2 years. That is just phenomenal acceleration. And that acceleration in the last 2 years, driven by easy money. By easy money, we mean lots of liquidity into the bond market, liquidity into the mortgage market. The cost of borrowing stays incredibly low. And obviously the demand for housing goes high, and you're creating lots of jobs along with that. So you can see how this manifests, but it's excessive, right? This is just too much. So you overstimulated the US economy, and in particular, you overstimulated the US housing market. That's absolutely clear. And once house prices go up this fast, people can't afford a house because prices have gone up too much, and they were already at a record high, which forces more and more people to rent property, which then obviously increases the cost of renting. So you've got a house price effect and you've got a rental effect, and the net result is that shelter inflation goes up dramatically. I can see how that comes about. That's quite easy to explain, I think. The difficulty is you've got to get this damn number down. Now, the reason you've got to get this down is that this is 32% of the basket. So this is by far the biggest element of the US inflation calculation, 32%. And you could argue as follows: the US will not achieve their 2% inflation target unless they get shelter inflation down. Mathematically, it's impossible. So you've got to get this number down. And it's going to start with the monthly numbers, right? You'll see the monthly numbers slowing. The problem is that when you look at the monthly numbers, if anything, they're still accelerating. Now, there is a massive lag effect with how shelter inflation is recorded, and that's where the complication comes in. These numbers that you're seeing here actually, in truth, reflect activity almost a year ago. And that if you look at rental agreements that are being signed today, they are lower. There's a moderation in rental inflation. If you go and rent a property today, the rental is being moderated down, absolutely. But that's not going to get this number down quick enough, because the rental calculation takes account of all of the historical rentals. And some of them historically would have been written at much higher levels. So it takes time. There's a lag effect for new rentals to come in to then bring the total number down. So what I'm trying to say is that shelter inflation will come down at a very slow pace. It's the nature of the data. But you need the number to come down in order to get the inflation data under control. So it's a critical factor to be aware of, is the leads and lags in shelter inflation. So when you look at it as an annual number, it's now at over 6.5% and approaching 7%. And the expectation is this number is going to go higher in the short term before it starts to moderate. And I've only got in my forecast this number coming down at the beginning of next year. So this is going to keep US inflation elevated for a while longer. And even when it comes down, it's going to come down very slowly. So it complicates the matter enormously. And what it's going to do is it's in the short term going to keep inflation higher for longer. And over the medium term, it's going to result in a very gradual moderation in inflation. Not much you can do about it. It's the technical way in which shelter inflation is calculated and put into the inflation basket. Now, the Fed will be aware of this, right? So they're not going to be absolutely beholden to this number. They'll look through those leads and lags to see what's the underlying trend, but it's not an easy thing to navigate. The good news is that house prices are now slowing. So this is the month-on-month increase in house prices for the US in total, right? And what I want to just draw your attention to is the last 2 months. In fact, the last 3 months. And you can see that there's been a moderation in house prices. And the last month it was negative, the first negative in many, many years. So what that's telling you is that the interest rates are starting to work. The higher rates, the higher mortgage rate, the withdrawal of liquidity, all of that is starting to do what it's designed to do. It's slowing the housing market. And house prices have topped out and they're starting to soften. And this will continue on. And we're getting lots of housing data that's showing a significant fall off in US housing activity. And so that's going to help to bring down rental inflation. But it's not going to come down quickly. The process of calculating rental inflation is a lagged process. So inflation in rentals will come down slowly over the next 2 years. So we just got to be aware of that when we keep looking at the inflation data. Fortunately, the Fed will know that. They'll look at this type of thing and be a bit more assured that the underlying level is behaving the way they expect. But in terms of the printed data, it's going to take some time. I hope that makes some sense, but it's an absolutely huge factor because it's such a big weight within the basket. The other thing to be aware of within the US inflation calculation, there's a question, if shelter is 32% of the basket, can't they get the data in quicker? That's actually a decent idea. No, because what happens here is that if you're renting property, right, you don't sign a new rental agreement every month. You could sign a rental agreement for a year, and then your rent is locked for the year. You're not going to go back and sign it in 6 months' time. You've signed the agreement. You've got to wait for the next year. So that creates a lag. So you've got to base the number on the agreements that are being signed. And obviously, rental agreements roll over all the time. They roll off and a new agreement is signed. And those new agreements are being signed at lower levels. I looked at some data this morning, which is saying that those agreements are coming out at the moment at 3% in increase. So let me just go back to this because it's quite important. So if you look at the rental inflation, it's at the moment over 6.5%. The current new agreements in property rentals, housing rentals, we're talking housing here, are being signed at 3%. So you can pencil in 3% here in terms of the latest numbers. But that's not what will be in the data, because that's only the latest agreement. What about the agreements that have been signed previously that then have time to roll over? So you would then have to change the weighting of the index to say, okay, let's only record the latest agreement. But that's going to hurt you at a future time, right? Because once rents start to go up, you're going to do the same thing. You're going to have lots of volatility in the shelter component. So they won't do that. They won't do that. They'll still follow the same process. They have to be consistent. This data goes back decades. You can't change your methodology at this stage just because you want a better outcome. But analysts will be looking through this to say, hold on, the reality is actually that this number has softened. And I know that sounds like a lot of noise, and I apologize, but it's critical to understand. All right, so on wages, the problem is a simple thing. Wages are going up now around 6%, anything from 6 to 7. I've seen some sectors, wages are going up 9%. There are industries where you're getting that sort of wage increase. And the problem for the Fed is that it's difficult to achieve your 2% target if you've got wages going up 6%. Very difficult. You'll get some benefit from productivity, but you're still not going to get enough benefit to offset that. So you've got to get this number lower. And unfortunately, the only way to get this number lower is you've got to slow down economic activity. And in particular, you have to hurt the labor market or the desire to hire people. So what you've got to try to do is take out what we call excess demand. There's excess demand for labor at the moment. So I'm just going to go back. There's a question, don't they use owner's equivalent rent? Yes, they do. So they use owner's equivalent rent for portion, and then they use the actual rents for people who are renting as a portion. But obviously the owner's equivalent rent is deduced from what's happening in the rental market more broadly. There's a question, why is shelter 33% of the inflation basket? Because it's that big. It's that big a factor. It's a huge component of what people spend their money on. Housing, the cost of housing. In the US, it's just what people spend their money on. That's why it's got that weighting. All right, so let's get back to wages. Wages are going up 6 to 7%. Now, you've got to get the excess demand for labor out the system. Now, that sounds terrible, right? Because you've got to hurt the labor market. But that's the only way to get wages down. Now, I want to illustrate that problem by looking at this. If you break down wages, now break down wages between something called a job switcher. That's the term they use, a job switcher, and a job stayer. So that just represents, the top line just represents people who are changing jobs during any time frame. And what it's illustrating is at the moment, people who are switching jobs in the US get a much higher wage increase. Now we know that, right? That's not a mystery. That's pretty much how you get your salary to go up. If you're a salaried employee, that's how you get your salary to go up. Your existing boss is never going to pay you that much more. So you find yourself having to move to another company, and then in that move, argue for a higher wage. That's a global thing, right? And that's always the case in the US. You can see that over a long period of time, job switchers get more money as an increase than job stayers, other than during recessions, right? So during recessions, don't change jobs. Obviously, in reality, what happens is what we call a job switcher is probably a person who got retrenched. They got moved out of their current job. They're forced to make another job. And in that transition, they have to settle for a lower wage. That happens during a recession. So I'm not saying that the job switcher during a recession, if you go back to the financial market crisis, a lot of the job switching was not by design. It was, well, I've got no choice. I've been retrenched. I've got to find another job, and your salary takes a knock. But under current circumstances, look at just the chart in the last 2 years. Job switchers have enjoyed a very healthy premium. It's been hugely beneficial to change jobs in the US. And some people refer to that as the Great Resignation. And it's been a big phenomenon. So what's unusual about this? What's unusual is the gap. If you look at the job switcher versus the job stayer, that gap is the highest recorded. In other words, it's been exceptionally beneficial to switch jobs in the US. Now, that's a message for the Fed. That tells the Fed there's just too much demand for labor. You can ask for any salary you want when you switch jobs. People have been that desperate to get you employed. So what you've got to do in the US is you've got to reduce this job openings. You've got to take away the demand to find the person in the first place, the job opening. And that started, right? It got to a peak of over 11 million jobs being advertised. The numbers come off to 10 million. 10 million is still exceptional, right? But you can see it starting to turn, and you've just got to continue on this process, which means the Fed will be looking at this saying, well, we've just got to carry on. We've got to put interest rates up. We've got to weaken the economy, and we've got to get rid of job openings. Therefore, we've got to take the froth out of the US market. We don't want to kill the US labor market. That we don't want to do. We don't want to end up with widespread retrenchments. No, that's not the name of the game. What we want to do is take away the easy ability to change jobs. And if you take away that ability to change jobs, you're going to start to dent the wage factor. Because now people will think twice about changing jobs. Not so easy. You'll be more inclined to stay where you are. And your boss will recognize that you don't have the option to move and then do you in even more. And that's the name of the game, which means wage pressure will moderate. You don't want wages to go negative here. They won't go negative. You don't want to have a complete collapse of the labor market. What you want to do is take away the froth. So this becomes a critical factor to watch. To what extent is that working? To what extent are interest rates working? And you would say, yes, they're starting to work. They're getting the housing market under control. House prices are falling. You would give that a tick, starting to work. You would see the rollover in job openings. And you're also starting to see, look at how many jobs are being hired in the US. Now, they're still hiring 200,000 people a month. That's enormous. But just kind of eyeball the trend in the number of jobs being added every month. And what you'll notice is there is a slowdown, not a collapse, but there is a slowdown in the number of jobs being created every month. That will tell you it's starting to work. The US economy is softening. The demand for labor is softening. But you've got to do a lot more. This all has to moderate a lot more, which means it takes time and it takes more interest rate hikes. So the net result of all of this discussion is telling you that inflation is going to come down next year. Let me show you my inflation forecast for the US. So inflation is going to come down next year, both at the headline level and at the core level. Absolutely. The interest rates will work. They'll do their job. The economy will slow next year. The housing market's already slowing. The labor market is showing signs of slowing. All of that will intensify next year. Absolutely. But look at where these percentages come out. They're nowhere near 2%. That's the problem. And part of the reason why they're nowhere near 2% is that you've got shelter inflation, rental inflation too high. So what this tells you is the Fed in the short term is going to keep hiking rates. They'll hike into early next year. Then they'll feel that they've done enough and they'll pause. They'll wait to see. And if these trends emerge, they'll feel a bit more confident. But when do they start to cut rates? Let's assume our forecast is right. When do they cut rates? You would have to say only 2024, because 23 is not enough of a moderation. And what we're trying to gauge in the financial market, in the equity market, is when does the financial market think you're at the point of maximum pessimism? When is it at its worst? Because that's when you want to buy, right? When are you convinced that this is the trend? When are you convinced that interest rates are at their peak? When are you convinced that the economy is slowing but won't go into a deep recession? That's the point of maximum pessimism, and that's when you want to go back into the equity market. And what you're doing is sitting there trying to judge that. And fund managers will try and time that. They tell you they won't time it, but they'll try and time it. Difficult to time it. And you get a sense that you're not quite at that point of maximum pessimism, but you're close. Unless something else comes along that really changes this game, you're close to that point of maximum pessimism. Why? Because you can see the interest rate starting to do its job. Housing prices are coming off, housing demand's coming off, the labor market slowly softening. Yes, rental inflation is a problem, but when you delve into it, you realize there's a big technical factor there. Interest rates are starting to do what you need. We're close to that point of maximum pessimism. I don't think we're there yet. I personally wouldn't bail into the market right now. I think we need some more bad news before we do that. And I think there is more bad news ahead, but we're not that far away from that point. I hope that makes some sense. Okay, let's talk about South Africa a bit. I'm a bit worried about time. All right, South Africa's story. So there's a big focus on energy, and when it's a bit like, and I want to apologize to people who are climate activists. I'm not trying to knock climate activists at all. I think there's a massive issue with climate change that's evolving, but we can't logically blame every single weather event on climate change, because when we go back in the past, even in the long past, we had lots of weather events, hurricanes, storms, floods. There were lots of weather events, right? That's the nature of the system. But when I listen today, every weather event, no matter where it is in the world, is being attributed to climate change. Logically, that's not right. There are extreme weather events, and possibly some of those are attributable to climate change, but not every single event, right? I think we're doing the same with energy here. By that, I mean, every time we're looking at economic data, we're saying, it's to do with load shedding. We had no electricity. That's why the economy is suffering. And there's validity in that, just like the climate change. There's massive validity in that argument. There's massive validity in the impact of load shedding. So you can see this year how extreme load shedding has been. Not that the other years were great, right? And you can see the progression, but this year has been exceptional in terms of the magnitude, the persistency of load shedding. And absolutely, it's had a big effect. But I want to make this point. I'm going to look at our industrial sectors, which rely very heavily on energy. So have a look at manufacturing and mining together. That's the volume of activity going back almost 20 years. There's no growth. For 20 years, there's been no growth. There's no growth now. I accept that. There's no growth now. But there hasn't been growth for 20 years. These industries have structural problems. It's not just an energy factor. It's got to do with a multitude of issues. It's got to do with a lack of investment. It's got to do with a lack of skills and training. It's got to do with regular strike activity, productivity issues, technology issues. There are lots of complications to this analysis. And yes, absolutely, load shedding is aggravating the situation. And it has worsened the environment, absolutely. But even if we took away load shedding, would I be convinced that these numbers would suddenly perform exceptionally well? No. There are many other obstacles, right? Now, just in case you think that this 20-year period is normal, let me again just illustrate industrial production in emerging markets, all of the emerging markets together. So let's keep this chart and just put emerging market industrial production on top of that, and you can see the difference, right? This is unusual for an emerging market to have this stagnant industrial activity. It's not normal. It's incredibly unusual, and it feeds into a stagnation of the broader economy. Very difficult to grow your economy at a vibrant pace when your industrial base stagnates, and when your industrial base has been historically a very important part of your economy. And that's what we've got. So we've got to be thinking more holistically about this problem. And that's, we've got to be saying, okay, energy is a big factor, but what about all these other factors? We've got to deal with them all if we want vibrancy back into industrial activity in South Africa. And then throw on that top the building sector, right? The construction sector. And when I look at construction, geez, this is a dismal industry now. This is the value in adjusted for inflation, value of building plans passed in South Africa. I mean, this hasn't grown for the last 15 years, right? If anything, it's diminished. Again, this is not entirely attributable to load shedding. Part of it is, absolutely part of it is. But part of it is just a lack of confidence in developing the country. And so the construction industry in South Africa has been in recession for 6 years in a row. There's a huge structural thing we've got to overcome in this country, and a lot of it relates to our engagement with the private sector. And a lot of that, when I say our engagement, the government's engagement with the private sector, it's not healthy. Absolutely, it's not healthy. I'm sorry. Government has to reform its engagement and understanding and acceptance of the private sector. And yes, there's this reluctance in government when, oh, now we've got to go to the private sector to get the private sector to help with electricity provision. You can hear the reluctance when you listen to the politician. But if we want this economy to be anything close to vibrant, we've got to have a different attitude towards private sector. Government cannot see private sector as the enemy, the outsider. Can't see it. It's got to see it as a partner. I don't think we're there yet. Yes, we're using the private sector because now the private sector can help out with the energy provision. Absolutely. But government would be well advised to embrace the private sector more fully. And here's the bizarre thing. Here's the thing I can't get right in my head. I don't understand why government doesn't do that. Because let's say that government embraced the private sector more fully. What's going to happen? The economy is going to grow. And when the economy grows, what's going to happen? Jobs are going to be created. And when jobs are going to be created, who's going to be voted into power again? The ANC. The ANC can simply claim victory. Any growth, the ANC can claim victory. Any job creation, the ANC can claim victory. So if the ANC is worried about a coalition government, what is the answer? Embrace the private sector. The private sector will grow the economy, create jobs, and then the government claims victory. They'll get voted in. Absolutely, no coalition. If the government is worried about coalition, then carrying on messing up the economy. That'll get you coalition. It makes no logical sense. Don't know. So the net result is you don't get investment. In this sort of environment, investment last year, the lowest ever recorded. And it's impossible to grow an economy without investment, right? And when you look at business confidence, it's been below the 50 index level, which means weak business confidence. It's been weak. It's not just load shedding. We say, oh, business is unhappy with load shedding. Yes, of course, business is unhappy with load shedding. Business has been unhappy for the last 15 years. Where's load shedding? Show me the load shedding on this chart. It's just one of many other factors business is worried about. The answer to South Africa is embrace the private sector business community and make the private sector business community convinced that you recognize them, you want them, you need them. And it's not an adversarial thing. It's a partnership. We do that, this economy flourishes. It's very simple. It's what happens around the world, rather than doing it reluctantly because there's a crisis. So business lacks confidence, yet they're sitting on all this money. Look at how much money businesses have in the bank. It sits at over $1 trillion, the biggest ever. The latest number came out, it's the highest ever recorded. And if you look at the rate of growth here, in the last 5 years, think how this economy has struggled for 5 years, last 5 years. The growth in cash has grown at over 7%. That's in excess of inflation over that time. Business, why is this cash growing? This reflects the lack of confidence. And why do I say that? If you analyze this data in 2020, when COVID hit, what did business do in South Africa? I'm talking big business. What big business did in South Africa in 2020 is they went and took debt. They increased their debt. And what did they do with that money that they borrowed from the banks? They put it into cash. Business accelerated their deposits in 2020. And when we talk to financial managers who are running business, that's what they did. They went and borrowed the money to take the money and put it in the bank just in case. That is how conservative South African business is. Just in case, what? I don't know, just in case. And the cash level goes higher and higher. The answer for government, embrace this cash balance. And the way to get this cash balance to work is make business confident. The more confident they are, the less cash they'll feel they need. And they've got a dreadful return out of this. If you look at where this cash is, this is terrible financial management. Most of this cash sits in overnight accounts, getting you the worst interest rate possible. Yet they persist with it because they want that money. Are they going to use that money? No. Are they desperate for the money? No. Are they in a crisis? No, but they still want the money. We're just going to remain stuck on this basis. Government needs to wake up. And so the net result is this: income per capita, GDP per capita just stagnates or goes lower. That's the purchasing power. And every business is now suffering from this problem. The consumer has no purchasing power, which means the business cannot flourish. Alrighty, so where's the good news? There's a couple of things. Before I get to the good news, I just want to, so there's a tendency when you get to October in South Africa now to kind of say, okay, we're ending off the year. We're getting some final presentations done and we're ending off the year. Unfortunately, from my perspective, the year has a long way to go. And I thought I would just jot down some of the things that are happening in the last 2.5 months of the year. So you've got the Chinese policy conference that's underway. You've got the medium-term budget. You've got ECB and Federal Reserve still having interest rate meetings. You've got the big climate conference, the UN COP27 happening in November. You've got the US midterm elections. You've got the G20 heads of state. The reason that's important is, what are the other G20 heads of state going to say to Putin? Putin's invited to that meeting. Will he pitch up, and what will that discussion be? And then we've got the ANC elective conference in December. That's a huge amount that's going to happen in the next 2.5 months, actually the next 2 months. So there's a lot of stuff we're going to have to digest. And so I'm suggesting that, yes, it's been a difficult year, but it's going to remain challenging for the rest of this year. Hence, I'd be a little bit cautious. There's a lot of critical stuff that will develop. And I'd be just worried that we're going to get more bad news rather than good news. And maybe next year is kind of a new dawn and we get more optimistic around markets. I think so. And we're at the point of maximum pessimism. I think there's an argument around that. But there's a huge amount of stuff that still has to happen this year. So there's a couple of points of good news. I think the medium-term budget is going to be decent. Tax revenue well ahead of budget. No let up there. Government's going to be able to show a nice tax revenue overrun. And I think government's going to show broadly fiscal discipline. There are issues. They've got to take on more of Eskom's debt. A lot of Eskom debt will have to be transferred away from Eskom. They've still got the salary increase. There are constraints on government. But I think the net result is going to be generally
a reflection of fiscal discipline, and I think it will please the bond market, credit rating agencies, and foreign investors. I think our inflation rate is still going to stay above 7% for the rest of this year, but next year I've got it down, coming down very nicely. And I think that's going to open up an opportunity for South Africa to diverge in terms of interest rates. But in order for us to diverge, we need other emerging markets to also be diverging. That's why Brazil is critical. So there's a possibility we could cut interest rates at the end of next year. In the short term, I think we've got at least one more rate hike. Let's call it 50 basis points at the last meeting of the year. But I think that we then go on hold, and hopefully we start to contemplate rate cuts towards the end of next year. I think the inflation number is going to justify it. And hopefully the world has been able to just differentiate between different economies in terms of interest rates, and that not everybody is beholden to the US. I think the tourism numbers are improving quite nicely. They got a long way to go back to their previous levels, but there is a nice acceleration that's unfolding. And I think in a year's time, these numbers will be a long way to being fully recovered. I don't think they will be fully recovered, but I think they'll be a long way down that path. And that undoubtedly gives us a little bit of a boost over the next 12 to 18 months. And then if you look at a range of factors, they're helpful, right? The revenue service is now monitoring luxury purchases. So if you go and buy something at Louis Vuitton, that detail is going to be transferred to the revenue service. The new energy plan from the minister is very compelling. Private sector signed up to that. Government continues to try and make it easier to do business. The spectrum auction, I think, was successful. I'm expecting more investment to be announced. I think we are moving ahead with prosecutions, very slowly still, but slowly that wheel is turning. I think, as I say, there will be fiscal discipline. You can actually catch a train in Cape Town now, and I think there will be a train or two running in Johannesburg. And then I think government is systematically embracing private-public partnerships. So there's enough here that gives us a better feel. When do I think that better feel starts to really show up in South Africa? Second half of next year. So I think it's still tough. I think it remains tough for the rest of this year. I think next year we start to see some light emerging, but it takes time to manifest. I think the end of next year, it looks more compelling. 2024, I'm getting more excited about. And I'm hoping by then, government has recognized that they've got to lift growth more fully if they're going to outright win the 2024 national election. So we're going to go into a very testing time for South Africa as to whether government's willing to embrace the private sector more fully. But I think we're going to have an easier path after the next 3 or 6 months. I think things will ease up. So what it ends up saying is that we're edging closer to this point of maximum pessimism. Globally, locally, markets have priced in a lot of bad news, right? And I think that there's a little bit more bad news to come, but I would be starting to just dust off the buying opportunity calculation and looking at this with a more sort of critical eye as to when to go back in. I'm close to the end of time. I just want to see. Question, what about SARS requesting details from tourists on move? Yeah, that's all starting to improve, right? The grey listing. Look, I think the grey listing happens. I don't know that we've done enough to avoid it, but there is a bit of a wake up going on, and the revenue service is part of that. And I think they'll be collecting more data. And there is more recognition that we've got to follow the cash. You know, up until now, you can walk into a Mercedes-Benz showroom and buy a car cash, and you're not going to get a whole lot of questions. You try that in Europe, you'll never get away with that. There would be so many questions. They actually can't take your cash. So we need to tighten up a lot of that. And that includes foreign tourism and just to follow cash transactions more clearly. Is the exchange rate factor of around 16 Rand to the dollar a thing of the past? Well, look, the fair value for the dollar, for the Rand, is still sits at around the 1530, 1550 level. So there's no doubt that the Rand is undervalued relative to a strong dollar. But I do think that if you want to get to that level, you've got to get the dollar to weaken. I don't think the Rand's going to strengthen against a strong dollar. So could the dollar weaken? Yes. But in order for the dollar to weaken, you've got to see a healthier global economy and therefore more risk on. And so you would start to factor that in 2024. But by then, you know, the fair value would have moved. So I would say don't think that the currency is going to remain this weak. I think as you get better news on inflation moving lower, ultimately interest rates coming down globally, and remember that's 12 to 18 months away, I think that will help to weaken the dollar and strengthen other currencies. But I wouldn't bet on the currency coming all the way back to 16 rand. Question saying resources will not help for long. What then? 100%. You can't rely on resources generating those tax revenues. So we can't build in expenditure. The message to government is don't look at the tax revenue and think you can spend according to that revenue. You've got to be more realistic. But I think the Minister of Finance will do that. What the message should be is we need broad sources of revenue, which means we need broad-based economic growth. And when we need an honest discussion about economic growth. How do you grow an economy? How do you create jobs? You have to embrace the private sector. There's no way out of that. And that message has to be embraced by government more fully. Okay, how do they have monetary policy tightening in the US while fiscal policy they are spending more? So there is a problem in Europe and the UK and the US to some extent, the UK being the epitome of the problem, where they try to actively stimulate from a fiscal perspective at the same time that interest rates are being tightened. That's a difficult thing to reconcile. Fortunately, the US, while they're doing some stimulus, the stimulus is not extreme, and it's certainly not enough to counteract the interest rate hikes. So I wouldn't accuse the US government of undermining the Federal Reserve. There are a couple of programs, but it's nothing like it used to be. And I would say broadly in Europe, you could argue something similar, where yes, they have got some support measures, but a lot of that support measure that Europe has introduced is to people who are undoubtedly vulnerable, in other words, on fixed pensions or old aging people, etc., where there is a bit more need for support. So I think the UK is a standout here in terms of bad policy, and therefore the markets punished the UK. I don't think it's as bad everywhere else, but the point's taken. This is not a time to undermine your central bank. The reluctance of government reluctance of government to embrace the private sector is largely due to the fact that their self-enrichment plans will be affected negatively. Absolutely, that patronage idea where you want to control the entire system so you can dish out patronage. It's a terrible model. It's a model for economic ruin. Absolutely. You've got to cut that out, and otherwise we won't be successful. Government is now considering assistance from the private sector with regards to energy crisis and Transnet. As long as government does not embrace the private sector, we will have very little room for growth. Government can't go it alone. Government can't hold on to all these state-owned enterprises and think they can engineer a strong economic upswing. It just won't happen. You need the private sector involved. And I think the message to government has to be, if you involve the private sector, it will strengthen your political position, not weaken it. That is actually the reality. All right, I've gone up to time. I hope that's answered most of the questions. I've skipped around a bit. Hopefully some of that makes some sense. I know there's a bit of detail. I apologize. It is a complicated environment. I think, as I say, I think it remains tough for the next 3 to 6 months. But I think systematically, once you've gone past the peak of inflation everywhere in the world, I think the environment will become clearer and they're less anxious. I would just urge people, don't wait until the news flow is overwhelmingly positive to go back into markets. You've waited too long. The market will preempt all of this. You do want a high level of pessimism to be prevalent in order to go back into the markets. It sounds bizarre, but that's the way markets work. And you've got to have a leap of faith that it will improve. I think the interest rates will work. I think they'll do their job. I think it will take time, but I think markets will react long before inflation is under control. Okay, thanks, guys. Thanks a lot. Yep, that's all for me. Cheers.